Vivek Kumar Devangan joins us now, Chairman and Managing Director of REC. Thank you for joining us. Allow me to straight away start with what is of immense market curiosity. I mean, the REC stock has done extraordinarily well. Everyone is happy the way the wealth has got created. Now, what came out from Reserve Bank of India, even though it is at a very draft stage, it created nervousness about how REC's profitability and provisioning would move. So two scenarios here. If the draft is implemented, how will that change life for you? And if it is not implemented, would you be indirectly started increasing provisioning?
You rightly pointed out that it is only draft guidelines and RBI has sought comments of the various stakeholders by 15th of June. This pertains to additional provisioning of 5% for the standard asset which are under construction phase. And that has to be implemented in a phased manner over a period of 3 years from March 2025 to March 2027. By March 2025, the provisioning of 2% has to be done. And by March 2026, this provisioning will has to increase to 3.5%. And by March 2027, the provisioning has to increase to 5%. Again, if the under construction project gets into operational phase, the provisioning is limited to 2.5%. And if it has positive net operating cash flow, the provisioning would be about 1%. But here I would like to make a distinction between non-banking finance companies like REC, who have been following Ind AS norm. As per RBI's income recognition and asset classification norms, this additional provisioning on account of under construction project is not to be routed through profit and loss account. Therefore, our profitability is not going to be affected at all. Our book value will also not be affected. The only impact that we can foresee is that it may affect our capital adequacy ratio and tier 1 capital. However, we have very good cushion already available. As against RBI norms of 15% of capital adequacy ratio, we have our capital adequacy ratio at the end of March 2024 was 25.82%. And with regard to tier 1 capital, our tier 1 capital was about 23.32% against the RBI norms of 10%. So we have sufficient cushion and we don't see any challenge to profitability of REC on account of draft RBI guidelines.
So, Mr. Devangan, can we take this on record that the draft guidelines from the central bank will not lower your book value or your capital adequacy?
The capital adequacy ratio, I told, capital adequacy ratio may be affected, but we have sufficient cushion available there. So we'll be able to absorb that impact on capital adequacy ratio because our capital adequacy ratio is 25.82% against the RBI norms of 15%. So we have cushion of more than 10% already available with us.
Even if capital adequacy comes down, I'm assuming all the possible scenarios here, and the number which you mentioned, which means that there would be no immediate requirement for any fundraise in FY26, even if the draft guideline is implemented.
Yeah, or in case we do have option, in case our tier 1 capital gets reduced by impact, impact is not going to be much actually because we're large cushion. So we have the option of raising perpetual bond. We can increase our tier 1 capital and tier 2 capital also can be increased by raising subordinate debt. So those options will be available with us, but we don't see that we'll have to resort to those measures.
What do you think is the rationale that the RBI may have behind introducing such guidelines? And do you think they want to curb the growth or just scrutinize under construction projects?
Now, in fact, we welcome the spirit behind draft guidelines issued by RBI. It is the spirit is that under construction projects need to be closely scrutinized. We need to monitor closely because in India we have seen that under construction there is likelihood of time and cost overrun. So this will put more scrutiny and closer monitoring to the under construction project. This will help in execution of the under construction projects.
Are you on track to become a zero NPA company soon?
Yes, that's what we had told after our board meeting, which was held on 30th April. We had made an ambitious plan. In fact, uh, we have been able to bring down our net NPA to about 0.86%, and uh, around 10, 12 assets are there which are yet to be resolved, but they are in the process of resolution. We have 7 assets which are heading towards liquidation, for which we already made 100% provisioning, and remaining 5 assets, the 5 operating assets, there we see that good resolution likely to happen through NCLT, and there'll be write backs of about 1,500 crore to 2,000 crore in the current financial year, and we are targeting to become net zero NPA company by the end of FY25. And you'll notice that not a single NPA has been added into our kitty in the last 9 quarters. So we would like to maintain this track record also.
So for next 3 to 4 years, what is your plan in place to achieve a AUM growth of about 20%? Because your base is becoming bigger. So 20% on this kind of a base, which means 3 years you will double.
Our asset under management had grown by 13% in FY23, and in FY25, our FY24, our AUM has grown by 17%. So we hope to sustain this growth momentum, which may vary from 15% to 20%, as we are targeting to double our asset under management by the year 2030. Even if we maintain this growth trajectory of 15-60%, we'll be able to reach we'll be able to double our asset under management by the year 2030.
One, you can raise money via the ECB route. And second, you can raise money via the green bond route where you get an advantage. Do you see mix of these two instruments increasing, and which will keep your cost lower and spreads higher?
Yes, we are making conscious efforts to reduce our cost of fund. In fact, last financial year, our cost of fund has been reduced by 15 basis points from 7.28% to 7.13%. And with a good mix of foreign currency borrowing and external commercial borrowing, and we are using innovative hedging techniques, and our cost of borrowing, we are targeting to bring it down to about 7% in the current financial year. And we'll be able to hold on to our spread of more than 2.8 to about 2.9%, and our net interest margin is going to be more than 3.55 to around 3.6%.
Current book, you would say, is coming from the traditional businesses, largely thermal led. And how much is coming from the new renewable business, something which you've been maintaining from 2-3 years now, that you want to grow that part of the business?
Yeah, our company has made a focused strategy to increase our renewable energy portfolio, which is about 35,000 crore. As of now, we decide that the renewable energy portfolio will see a tenfold increase. Our renewable energy portfolio will increase to about 3 lakh crore by the end of 2030. It will constitute about 30% of our asset under management.
The cost of financing in renewable, is that same as the thermal?
We have been able to raise, as you rightly pointed out, that we have been raising green bond. Last year, we had raised $750 million green bond. Then we raised global yen bond, and this margin of about 12 to 15 basis points while we raise green bonds. And by innovative hedging techniques, we are targeting to bring down the cost of our external commercial borrowing, which will help in financing our green projects.
And given that, you're talking about the long-term growth trajectory, you have a 15 to 18% growth trajectory that you're envisaging over the next 3 to 4 years. Give us a little bit more clarity as to which are the segments that are going to be driving this growth.
One is, of course, renewable energy segment, where we have been financing an entire spectrum, varying from large hydro projects to pumped storage projects, then solar module manufacturing projects, wind projects, solar projects, hybrid wind and solar projects, then electric mobility segment also we are targeting. So we'll cover the entire gamut of the renewable energy projects which are coming in the country, because country has made an ambitious plan to install about 500 gigawatt capacity of non-fossil fuel-based electricity capacity by the year 2030. At present, we are at around 191 gigawatt capacity. It means that about 309 gigawatt capacity is to be added in next 6 years. Another aspect that is to be noticed, that since renewable energy is intermittent in nature, we need to have storage solution. Until unless commercially viable storage solutions are developed, the coal-based capacity will provide the grid stability, and it will provide the base load. That's why the technical arm of the Ministry of Power, that is Central Electricity Authority, has made a projection that country will require another 94 gigawatt capacity of coal-based thermal power plants by the year 2032. So in next 8 years, this additional coal-based capacity, which will come in brownfield projects, will be coming. That will give us another business opportunity.
So good speaking with you. Appreciate you taking the time out and joining us on ET Now, giving us a lot more clarity on those norms, as well as the growth outlook and potential for REC.